Papa Deal event on now.
Just seeing Goldcorp boosting its annual dividend by 11%. Little breaking news there for you. Let's talk banks, though. We have Richard, who's in Toronto. Go ahead.
Oh, hi, Mark. David, I value your opinions. You always give good, solid advice. I have Bank of Commerce for the dividend, and I'm wondering if the banking sector is getting a little long in the tooth. So maybe there's another dividend stock you could suggest as a better vehicle. I don't know whether it would be something like BCE or that's up to you. I'd love to hear your opinions.
Sure. So, Richard, first of all, on the big Canadian banks, in general, if the market hangs together here and continues to work its way higher, driven by some of the liquidity in the market, then these things are going to perform just fine. I think that, in general, the dividends certainly are going to continue to get paid and they're going to continue to grow, albeit we think the dividend growth is going to be slower than it has been historically. So the caveat is you're not in a bad spot to start with. We think that the long-term theme in this market is dividend growth, however, and you'll get a more significant total return if you can pick up the yield, plus you get some growth in the capital value. And whereas for the last 15 years, the financials have been big winners leading up to 2008 and actually, after the fact, I think that the long-term secular growth rate in North America going forward is going to be better found in energy infrastructure. So the valuations are higher, and I think that they should be, but I think you're going to get 8 to 12% dividend growth as opposed to something less than that in the banking group. So, I've been a long-term bull on Interpipe. And this is it's one of our largest positions. It continues to chug along, it continues to give us some growth. The growth is coming from the opportunities that they have to continue to build new infrastructure for the oil and gas industry, which is in a deficit when it comes to energy infrastructure assets. So they're going to continue to build pipe, and they're going to continue to build storage, and you're going to get a nice dividend yield in the way. So the yields are comparable. The dividend growth is going to be, I think, more significant, and over the next 5 years, you're probably going to wind up with a bigger win with an Interpipe than you would with CIBC.
You mentioned you hold some U.S. banks. Do you hold any Canadian banks right now?
No, we do. Yeah. We do own Canadian banks, and we have a smattering, 4 or 5, but we are underweight the group in general, and we have more U.S. banks.
All right, then you talked to Pharma earlier. Let's get back to that theme. Here's an email from Ali. Actually, no, I guess we're going to Rick. He's in Strathroy. Go ahead, Rick. No, we doing Rick in Strathroy?
Yes.
Go ahead.
I was just wondering, what about AGF management? You think I think it's paying about 10%. Is this a good one to get into, or is it a quota laggard? If you want to call it that, I'll just wait. I'll listen to what you have to say. Thank you.
Okay, Rick. So first of all, if you want to buy this group, if you think stock market's getting stronger, and right now we're in a stronger market, and so certainly people are looking at this group. We're seeing money move into some insurance companies. We're seeing money move into banks. We're seeing some money move into asset management companies and capital markets companies. In that group, the most predictable group probably are the asset management companies because they have recurring fees. The problem, of course, is if your recurring fees aren't growing and if they're going backwards. So AGF, historically has been a great business. They had good returns over time. More recently, over the last few years, they've had difficult returns, and as a result, they're getting net redemptions as people sell the units of their funds. That's a tough tide to turn. And so in the short run, I don't see anything changing that. Their returns haven't gotten a lot better, and as a result, they're having a hard time selling their funds. So if you want to own the fund management business, I think CI Financial is one that you could own. We own shares. They've had good near-term performance. They're getting good net inflows into their funds. As markets get a little bit better, money tends to work towards fund companies that have had better recent performance data. So I'd prefer to look at something like CI than AGF.
Maybe we can throw up the other CIX. Nice looking chart, actually. It's started to move. Here's Ali with an email on Novartis as we get back to having David talk about Pharma, NVS. Do you like this? Hold it?
So I talked about Pharma as a group that we like, and let me just talk about the characteristics that I think make this attractive. It's a group that was out of favor for 10 or 12 years. So it's an under-owned group. This is a very large industry. It plays directly into demographics. it's a very predictable cash flow stream that you get from most of these businesses. Some of them are better, some of them are worse. Novartis has some very, very good generic products. They've got some good diabetes drugs. And what's happened is investors have started to look beyond the edge of what they call the patent cliff, which is where some of the big drugs come off patents and move to generic products. So you're going to get high single-digit revenue growth going forward. You're going to get earnings growth, and you're going to get dividend growth. So this whole group, I think, has something that everybody's looking for, which is some measure of predictability. So Novartis, I think, is a good one. I think you could hold it on its own or within a basket of pharmaceuticals, but I think in general, you've got the sector on your side, you've got dividend growth on your side, and you don't have a lot of risk.
And it's right up around an all-time high here at 64.44. Let's talk to Bill. He is in Winnipeg. Good evening.
Good evening. Thank you for taking my call.
Sure.
An excellent program, Mark.
Thank you.
My question is this. What is your guess outlook for BCE as to its what's happening, if anything, with their dance with Astro Media, and what is his outlook on the dividend growth? Thank you. I'll hang up and I'll watch.
Okay, thank you, Bill.
So I probably won't speculate on the Astro Media, but what I will say is that, first of all, telecom is a sector that we like. It has those same characteristics, predictable cash flows, and not a lot of risk to the economic cycle. If I had to choose between BCE and TELUS, I'd probably choose TELUS because they've been more predictable from a dividend growth standpoint. BCE, you're getting a 5% yield. You know, so what's wrong with that in a world where, you know, 10-year bonds are 1.8, 1.9%? I think that's very attractive. So stock pulled back a little bit late part of the year, like a lot of dividend payers did. It's performing well. It's not going to be rocket fuel, but it's going to be a steady performer. And I think that a lot of the investors in a BCE or a TELUS aren't necessarily looking for rocket fuel. They're looking for a consistent dividend yield, one that will grow a little bit over time. And I think that you're not going to get hurt with BCE.
And BNN is a division of Bell Media, which is owned by BCE. We'll take a short break here with David and come back with your questions on North American large caps after this.